Hello and welcome to Movie Market Podcast. I'm J.R. Gondeck, as always, joined by David Sokolovsky. And this month, Matt joining as well, our portfolio manager in fixed income, give some thoughts on what's happened in the bond market so far this year and a little bit of what to look for ahead with interest rates. And David, let's start kind of recapping, overall markets in February, which for the most part, a lot of the market indices given up a lot of their gains for the year.
Yeah, Jared, thanks. So kind of like you said, February really was a very volatile month. Um, and as you saw, the S&P turned negative very briefly before finishing the month, slightly up. The equal weighted index continues to outperform. And what we've seen is actually high dividend paying stocks have done much better than the S&P 500, and international has done fairly well as well. So as we've spoken about in the past, we've talked about, is this going to be the year of international? We're now starting to see a little bit of a trend emerge with particularly developed markets having a very strong month. And some of this volatility has been caused by um, either tariff threats or just earning results, potentially softer economic data. So really just a mix of information that's coming out, but painting a kind of a mixed picture.
Well, and David, on the international front, right? I mean, as you said, international markets, generally speaking, have underperformed for years and years. But as we set the stage, looking now and ahead, we'll get into some of the forecasts from Vanguard and others, kind of alluding to maybe the value out there. And in general, the U.S. markets and the U.S. economy is growing much faster than the rest of the world. So there's good reason for the outperformance. Having said that, as you look ahead, the valuations overseas are dramatically less than they are here in the US. There's relative value, maybe a little bit of reversion of the mean, and rebounds. And then just following some of the headlines we've seen, you're seeing more capital raising and other flows of funds moving overseas as well. And like I've said, you could see international markets double over the next 3 years, and they're still going to be, in general, probably far cheaper than US equities. So Matt, let's maybe look a little bit, recapping the bond market and maybe the two-pronged challenge that the bond market and really probably overall economy and stock market are facing.
Yeah, so far this year we have seen pretty volatile bond market, especially in the 10-year space. We started the year right around a 4.5% yield. The first month of the year, there were more worries about inflation, and you saw yields rise up, especially with some of the tariff talk out there. In the last couple of weeks, though, we have seen kind of inflation take the back seat, and growth has really picked up, and growth scares actually in the economy, which you've seen in some of these economic numbers that have come through recently. So that's the bond market has taken note of that, and you've seen yields come in significantly, currently sitting at about a 4.23, I think, on the 10-year roughly. So going forward, I definitely think you could see yields continue to grind tighter, grind lower, just from these growth fears, and especially if you get some ambiguity in the stock market, you have a flight to quality trade. However, looking at factors later on in the year, whether it be inflation, supply concerns, things like that, there are definitely things that could, push bond yields back up potentially by the end of the year. So we're definitely taking a cautious approach right now.
And
Uh,
let's look at the growth fears, right? I mean, GDP is one example, right? So you kind of look into that as a growth scare, right?
And this is data that just came out today. So on some economic activity, I mean, it's a pretty significant drop. I think you see the expectations for GDP were nearly 4% as the estimates started going. Those numbers should be taken with a grain of salt because as we know, as more information comes out, it tends to even out the index. And so earlier numbers have a larger impact. But you do see this very large drop off as it was reported today uh, as far as Q1 GDP estimates. So if you have this and it persists and activity doesn't pick up, you could look at a potential economic slowdown.
Well, and just, for listeners, right, what David's talking about the green line, right? And the green line is the Atlanta Fed GDP estimate, which for the most part started around 3% and then has been adjusted lower. And then all of a sudden, this last estimate with consumer spending dropping off went negative, right? So we went from almost 3% expectation down to potentially negative first quarter GDP. So Matt, bringing it back to the bond market, and maybe looking at inflation as too, kind of what do you forecast, looking ahead based on the challenges between those two?
Yeah, it's definitely, a tough one to do because when looking at the bond market, we're investing a lot in corporate bonds. So there's, two main components to that. One's going to be the corporate spread over treasuries. So this is just the additional interest rate that investors want to get from investing in a corporate bond versus a treasury bond. And those are at historical tights right now. So the compensation investors are requiring to own a corporate bond over a treasury bond is pretty low. The other one is going to be the duration risk, which is going to be a measure of a bond sensitivity to interest rates. So basic, that definition of inflation. If you have a bond that you purchase at 1,000 and the duration's 5, if interest rates were to go up 1%, you could expect that bond price to fall 5%. On the flip side, if interest rates were to go down 1%, you could expect the value of the underlying bond to go up roughly 5%. So inflation and duration is definitely going to measure the sensitivity to interest rates of individual bonds. But back
And
to
Matt, looking at this corporate spread chart, like, in general, what's the premium corporate bond investors are getting today versus maybe where they normally are?
Yeah, so looking at this chart on the screen right now, this is showing corporate bond spreads over the past couple of years. And as you can see, right now we're roughly sitting at about 50 basis points, maybe a little higher than that even. And that's the amount that a investment grade investor would require over the treasury to buy corporate bonds. This has been as high as 120, 130 a couple of years ago. So when you have these scenarios and you look at, well, what could happen into investing in fixed income, if there is a growth scare, you will probably see corporate treasury bonds continue to go lower, but you could see the corporate bond spread start to widen out, offsetting the benefit from those lower yields on treasuries. So you definitely want to be careful on what you're buying. And what we have been doing is upgrading credit quality over the past couple of months because of that corporate bond spread. So if I'm giving up, a little bit of return, but I'm increasing my credit quality and protecting my principal, that makes a lot of sense in this kind of environment, we think.
Well, especially, Matt, if recession fears and growth slow is on market's mind, and the data, generally speaking, this month has been a little more pessimistic to support slowing economy. What do you typically see as we hit slowdown in the markets or potential recession from a corporate spread standpoint?
Typically in a recession, you see spreads move out. So spreads will get wider. So you would move off that 50 basis point spread and go something more along the lines of probably 90 to 100, depending on how bad the recession or the growth fears are, because you have a little less confidence in these companies' ability to generate cash and to pay their interest and debt on time. And that's kind of the give and the take. So when the spreads between an A-rated bond and call it a single B-rated bond compress significantly, you would want to sell out of your single B-rated bond, buy A-rated debt or buy triple B-rated debt and get better credit risk, than you would in an environment where spreads are very wide. Then you can kind of pick and choose some of these higher names that you do your research on, and you can capture additional yield on that. But right now, you're not being paid to take credit risk, in our opinion. So we have been significantly upgrading the portfolio across the board.
And David, let's
sounds
turn.
like safety is the name of the game. But I think even if you look back, you are being compensated for, even holding cash and treasuries, right? And so kind of like you said, in this low spread environment, you're just not really being paid to take the risk, and you might give up 10 or 20 basis points, or correct me if I'm wrong here on what that number is, but one option is to get a 6% bond, with a much lower credit rating and a lot more risk, and the other option is to get a 5 3/4 or a 5 1/2 or something like that. You might give up a little bit of upside, but it's very prudent to protect the portfolio at the moment.
Well, and
Exactly.
David, let's talk about the economy, right? So what's feeding this, overall concern by the markets and the bond market about a potential slowdown ahead.
Well, we've talked about this a lot, throughout these recordings, and really the largest driver of the U.S. economy is the consumer, right? So 2/3 of the economy is driven by the consumer in some fashion or another, and what you're seeing is consumer confidence has shifted drastically lower. You also see retail sales and just activity in January slower as well. And then if you look at the housing market, you have a combination of higher interest rates, higher prices, higher insurance, and higher taxes that are a headwind to that segment. So you're really bumping up, and we've talked about it for a little bit, as far as the consumer getting stretched, the concerns about inflation, but we may be reaching that point where the consumer is really looking to scale back. They're not looking to spend as much money, and again, it can become a self-fulfilling cycle, right? So if I'm concerned about the economy and I decide to not spend, I'm going to save that money. I'm not going to buy something. That then reduces, the amount of revenue that goes to that business. That business doesn't pay its employees. And so consumer confidence really drives the activity, and the perception can become the reality. So if people are pessimistic, because they're concerned or just don't want to spend at the moment, or don't have the ability to, then it becomes a self-fulfilling cycle where you then have the slowdown potential in the economy.
Well, and David, when you dig into consumer confidence, right, it is such a big deal to your point, right? Because if I don't feel good about the future, I'm going to hunker in a little bit. And it doesn't matter if you're investing in stocks, if you're spending, if you're a company looking to make an acquisition, if your confidence is a little less, you're going to be on the sidelines a little bit, so to speak, and that could naturally move to a bigger slowdown. And the other thing, looking at earnings reports, for the most part, we're pretty solid across the board. Right. But again, the challenge is just the outlook. We've had such a run in large cap equities the last 10 or 15 years, and the growth and expectations, has been a little bit of a disappointment, right? Take a company like Nvidia that was out this week, right? Great results across the board. For the most part, the outlook was better than expected, but then there's some challenges on margins and, maybe the growth forecast a little bit less. So the stock was up a little bit, but then rolled over pretty good. And when you look at the Mag 7 stock charts, a lot of them are flat to down over the last 7 or 8 months. So when you look at the opportunity to rebalance and look at where the opportunities are in this market, as you started the conversation, David, the equal weighted S&P index is outperforming the S&P, right? Because the breadth of the market is where, the value is. Because we've had a lot of questions about Warren Buffett. What does Warren know, right? He's raised a lot of cash, right? He's got a record cash pile right now. And for the most part, I think he's articulating what we're talking about. We've talked about Goldman Sachs in prior recordings predicting the lost decade ahead, where they're predicting 3% growth in the S&P over the next 10 years. And their argument is just math, right? The companies are already 3 trillion. You got to grow into valuations. And I think more than anything else, if you think about Warren Buffett, he's got so much money under management, it's hard for him to maneuver and buy smaller companies or mid-size because he owns the entire company. So I think he's really having a little bit of dry powder, waiting for better opportunity as valuations and maybe some of the big cap, stocks fall a little bit in the weeks and months ahead. Meanwhile, he's clipping, 4% on his money market. So on 360 billion, it's still a lot of profit.
Yeah, Jared, I think kind of like you pointed out, I mean, you have other concerns as well. You have, earnings that have been better, but if you look at a more of a value type of a company, and so, you hear a lot of conversation about growth and value, and over the course of the last year, growth has certainly done better than value. But if you start to kind of peel that back, growth companies are typically those that have very high earning or very high earnings growth, and their prices are a much higher multiple of their earnings. So the expectation is that those earnings are going to continue to increase at a rapid pace. Whereas if you look at a more of a value company, right, they're selling at a smaller multiple of earnings. So a growth company might have a PE of 50 in some cases, right? A value company might be 10 or 12. Growth can have a much higher PE than 50 also, but generally in that range, right? So companies that are more of a value, companies that pay a dividend, have some stability. If you do have economic potential slowdown, you're not necessarily going to buy less toothpaste or gasoline, right? But you may cut back on some luxury items. So it's going to be an interesting market to see, and obviously, having some protection is going to be important, but value continues to be an interesting area for income opportunities as well as just protecting the overall portfolio.
It kind of tie things together here and look at the cautious tone, probably near term and outlook, putting things together, right? You have this tariff overhang where the challenge the markets are facing is you don't know how much and where and which country and when, right? So that continues to be a concern of the overall market as to which way those go. And markets just don't like uncertainty. So in the short run, as growth rates are slowing down, you've seen a lot of rebalancing out of growth companies to valuation, which is to me a healthy sign of this market where it's not a one-way momentum market. You can really do analysis and looking at the run of the markets. There's nothing wrong with rebalancing. As Matt talked about the fixed income markets, he's done a fantastic job, protecting principal and upgrading quality as we enter a potential slowdown. And it's the same with overall portfolio. And that's the same with international. We've increased our allocation to international this month, looking for that potential continued momentum of money's moving overseas and just really reversion to mean, taking profit on what's done well and rebalance into, an overall portfolio. So I think for the most part, although we're cautious here near term, the economy is still on, for the most part, decent footing, and there are opportunities. And I think our conclusion for the year is diversification is back. And it's really about making sure you're diversified, not over concentrated in the areas that have done too well, and be cognizant of the fact that you can take some profit, pay some taxes, and really protect your principal, near term and looking ahead. So with that, we want to thank you for tuning in. We'll touch base next month.
Thank you.
Thank you.